Hello friends, welcome to my weekly market outlook video. In this video, please pardon me if I sound a little excited because the markets have panned out exactly like I have been advocating in my videos and even my social media posts. I've been warning you that the markets are precariously poised and the bulls need to push a lot more harder to keep the markets higher. As a matter of fact, the WhatsApp updates that I sent out to you on the 18th and 20th of January, which in no uncertain terms warned you in my own unique style using my 360-degree worldview about why the markets were likely to fall, should have warned you that a big dip was coming. If you wish to be included in this free WhatsApp broadcast list, please send me an email in the ID that shows up in the screen, and in the description below my video, I have given you my contact coordinates. Please do connect with me and we'll get you started at no cost, completely free. So, last week I told you that the bulls were at a disadvantage, and the reasons were rising energy prices, which were likely to hit sentiments. And I also told you that in my video dated 18th of December, that the declines would present you with opportunities in selling short if you were a tactical, which means a short-term trader, which is precisely what happened. Last week was a market for the bears, for the sellers, and if you could simply get in and get out at a good pricey points, you could have simply made a killing on an intraday basis. So that is what the market was all about, selling last week. We are going to see that in the charts in the coming few minutes. So rising interest rates were a specter that haunted the markets also. This is something that I have been talking about for a very long period of time on my social media accounts, that guys who write the big ticket checks are demanding higher interest rates because inflation is rising and cost of funds will go up, which is not going to go down well with financial markets. Look at the way base metal prices fell last night. Look at the way equity markets are selling off, and you know what I mean. So that strategy of selling worked out beautifully well for tactical traders. I also hope that you noted, if not took outright advantage of those two WhatsApp broadcast updates. I promise to keep pursuing my 360-degree worldview and the fetish, the obsessive behavior that I have with keeping ahead of the markets. Even if it means that I appear wrong for a brief period of time, so be it. But I would prefer to keep ahead of the markets. That is how our trading model is made. So, those who were wondering what was the basis, the method, or the underlying reason behind those updates, I use the popular analogy of the two marshmallow hypothesis, which is very popular in behavioral finance. You can Google search that, it'll stand you in good stead. So let's now get right into what happened last week so we can guesstimate as to what we can expect in the days ahead. Coming up on your screen is a weekly market roundup window. And that tells you that the fall was led by the Nifty, and the decline was therefore relatively broader based. Bank Nifty, of course, followed suit. The dollar rose in the overseas markets as the Dixie figure shows, and even in the domestic markets, we saw the dollar firm up as the USD INR shows. The fact that bullion, which is gold and silver, rose in spite of a strong dollar tells me that investors are returning to safe haven buying. Normally, a strong dollar means weak gold and silver prices, but now both are rising in tandem at the expense of higher risk assets like bonds and equities. The National Stock Exchange lost 3.26% in market capitalization on a week-on-week basis. Now, friends, this is something I want to share with you. I've been in this market for 36 years now, and I can tell you with a certain degree of look-back knowledge that a week-on-week decline of more than 4% in market capitalization in the Nifty invariably works to the disadvantage of tactical bulls, which means short-term intraday or swing trading bulls. So we've come to a loss of 3.26% in market cap. Just watch out. Bond yields rose further, and the market-wide position limit chart that you're seeing on your screen seems to indicate a very mild rise in MWPL on a week-on-week basis. The fact that MWPL has failed to cross even the 30% in the third week of the derivative cycle tells me that risk appetite is quite poor. Now, this is something that I wrote about in my Live Mint column as well. Now, my Live Mint column comes out every Monday in a very popular newspaper, the Live Mint, which is the Hindustan Times Group newspaper. I send it out to you as a WhatsApp message, as a hyperlink, which you can read for free. Get included by sending me an email on the address that I mentioned before, and I'll have you in our broadcast list. Now, monitor the MWPL daily because I update it on my social media account. So do connect with me there. We can help each other become better traders. My contact coordinates are shared at the end of this video as well as in the description segment below this video itself on YouTube. Now for the turnover graphic on your screen, which shows a period high, which is a 20-day high in the index futures. Do note that these are cumulative 3-month series, which is January, February, and March futures. And where the stock futures are concerned, they hit a 16-day high in turnover. Now, note how the volumes have jumped on Friday, which is when the market sold off very viciously. That tells me that traders participated in the sell-off. I personally favor higher trader participation in any kind of market, not because I favor a bull market or a bear market, but higher volumes mean you avoid very wide bid and offer spreads, something that you're seeing on your screen. Now, these wide spreads result in very, very large price moves, even on very small amounts of selling and buying. This screenshot which I shared with you of a bid and offer spread being wide is of Bajaj Auto. Note how Bajaj Auto moved wildly in triple-digit rupees levels on Thursday and Friday. This is what I mean when I caution you on my social media accounts that you should avoid counters which have high spreads. My fellow systems traders will identify with this immediately. The basis chart on your screen shows a crashing decline in the futures premium over spot. While you may argue that the approaching expiry is responsible for this fall, but note that the steepest decline in basis was seen on Friday, which was the lowest point of the market last week. Now, this tells me that the bulls were unwilling to pay premiums in the future over spot. Friends, I would want you to watch out for the fact whether the basis inverts. What is basis inversion? Basis inversion is a simple phenomena where the futures price is trading below the spot price. Why does that happen? Because the selling pressure simply escalates. If this happens, if basis inverts either of the Nifty or of the Bank Nifty, or maybe in the worst case scenario, both, be very, very alert. That means the bears are going to attack a little more proactively. So do watch for basis inversion. Basis chart is also something that I share on my social media accounts every day. So take heart. I'm there. You can always revert back to me and update yourself on a day-to-day basis. And if there's anything that I need to update you with, which is substantial, noteworthy, and desires your attention, remain assured I'm always there on WhatsApp. Now for the showstopper, the best indicator that we have shared with you so far from our in-house exclusive trading statistical model, the IBEX, the impetus chart. Now you won't find it elsewhere because like I said, it's exclusive and it's in-house. It shows the Nifty impetus started turning higher from Thursday, which is when the Nifty started falling sharply. The fact that the impetus rose on falling prices tells me that the falls are accelerating. As usual, I will update you of any sizable changes in impetus via special updates. Stay tuned and monitor your inbox. Let's now proceed to see the footprint of the four categories of traders and see who is doing what. The FIIs were net short in index futures by 381 lots, which was earlier net long of 55,391 lots. In stock futures, they were net long of 51,757 lots, which was last week a net long of 1,17,215 lots. So FIIs are very, very clearly and undeniably offloading their long positions. Let's go to the DIIs, whose index net shorts have come down to 43,299 lots, which last week was net short of 55,109 lots. Where stock futures net shorts are concerned, they've come down as well to 16,22,465 lots, whereas last week it was 16,29,774 lots. So DIIs are very clearly cutting shorts, but mildly. Let's now see what the prop traders are doing. These are super sharp traders. Brokers own proprietary trades. They are second best to insiders because they know who's buying and selling and how much. So prop traders have turned net long in index futures to the extent of 1,509 lots, whereas last week in index futures, they were net short by 9,221 lots. Where stock futures are concerned, they are net long to the extent of 1,92,215 lots, whereas last week they were 1,73,953 lots long. Prop traders are clearly buying. Let's now look at the retail traders. Now this demands specific attention because so far the retail guys have been doing all the heavy lifting and they've been buying single-handedly. The index futures net long positions have jumped where retail traders are concerned to 42,171 lots from last week's 8,939 lots. Where stock futures net longs are concerned, they have also jumped to 13,78,493 lots from last week's 13,33,319 lots. So the retail is single-handedly the buyer of last resort. Do note that most of the incremental long positions of the retail have come on a major downtick on Thursday and Friday, which means they have actually bottom fished when everybody else was selling. Now, there is a red flag here, a mild one, of course. This can raise volatility. If prices fall, then the retail starts to sell what they've bought on Thursday and Friday. Prices will dovetail and volatility will jump. So be particularly careful about this. Friends, I now come to this week's most important point. Although a lot of people don't understand this, a lot of people even under-discount it, but in my humble opinion, the most relevant market last week was the bond market. Bond markets are understated, ignored, and feared and even treated as boring by many traders. But it'll surprise you to know that bond markets are the source of all money for other asset classes. So don't let anybody tell you that bonds don't need to be watched, especially if you're a bank nifty trader. So, what I saw last week, I shared with you my worries based on hard facts, of course. The Saudi spokesperson, Brigadier General Turki al Maliki, about 8 days or 10 days ago, warned that he had irrefutable proof that the Houthi militia was targeting Saudi Arabia using missiles and drones from two port towns in Yemen called Hudaida and Salif. I even updated my social media accounts to that extent. Now, he threatened to bomb these two port towns, which basically made the markets nervous, which is why crude and oil prices jumped. All right. The Houthis, instead of being quiet and subdued, actually went out and using drones attacked the Saudi Abu Dhabi International Airport. We saw how two Indians were one of the three people who died in this attack. Now, as I record this video on Saturday, I'm seeing news how the Saudis have bombed the city of Sada in Yemen. It has resulted in deaths of 70 people. Now, this nervousness will come on Monday in our markets because it has occurred on Friday night, well after the Indian markets have been shut. If you were wondering why the Dow Jones Industrial Average fell on Friday, it is because of this bombing attack by the Saudis on Sada, amongst other reasons. Of course, this is not the only reason, but it is amongst the other reasons. And the bond market, my friends, will be the most important market and the most important trigger to tell you whether equity markets are going to fall or not. If you ask me why bond markets are important, because they tell me whether equities want to fall or rise. Simple. So, last week, as energy prices rose because of problems in both Eastern Europe, where Russia is trying to take over Ukraine using Belarus as a springboard, or it is Saudi attacks threatened in Yemen, and this is basically spooking oil and gas prices, which are rising, and bond yields rose, which means bond prices fell. Now, these are both negative factors. I posted this on my social media accounts, which you can see on your screen as a screenshot. And I've advocated to you that you should be diversifying some funds into sovereign guaranteed, 100% government guaranteed bonds. We should also be doing what is known as laddering in the bond market. It's something that I have been tweeting for a fairly long period of time. Now, laddering will help you achieve optimal yields with 100% central government guarantee. So, as you can see, it might appear boring, but hey, a 7, 8, 9, or maybe sometimes 10% government guaranteed yield when the stock market is dovetailing the way it is, I think I'm much better off. Thank you. So, as you can see now, equity markets are not a one-way ticket, and they also fall. A lot of newbie traders are going to realize that. On the global stage, inflation is at a multi-decade high, and that means big ticket check writers will ask for higher interest on their capital, which means cost of funds will rise in 2022, which can lead to pressure in equity and bond markets. Now, I've been telling you to ignore bond yields only at your peril. Add the forex pegs and inflation metrics, and you know that you're actually trading with one eye closed. In the year 2022, if you don't understand what bond markets are, you've lost out. You're going to be behind the curve. It's as simple as that. Don't trade or invest with one eye closed. Get a three-dimensional view of the markets by monitoring all asset classes. So, let's now go to the Dixie, the US dollar index, which managed to log gains on a week-on-week basis. And that exerted downward pressure on our market since it triggers imported inflation. Why imported inflation? Because anything that is imported becomes more expensive if the dollar is high and the rupee is down, and oil and gas, which are as it is imported, causing commodities, are rising in price. And if the dollar also rises along with it, it means double the inflation. So the benchmark US dollar index, the Dixie, fell on 2 out of 5 trading sessions last week. But Tuesday's gains were sizable enough to see to it that the Dixie ended the week on a positive note. Now, if the Dixie continues to rise, it can exert downward pressure on markets in the week ahead as well. The price has closed a tad below the 25-day exponential moving average, which is a proxy for 1 month long holding on cost of bulls, which means the short-term outlook is weak for now. Let's now turn to the weekly chart where we see a bullish candle that is comfortably perched above its 25-week exponential moving average, which represents approximately 6-month holding on cost, an average cost of 6-month bull, which means that the medium-term outlook is positive for now. Last week, I advocated a range between 96 and a quarter on the upside and 94.05 on the downside, which held perfectly well. In the coming week, I expect an estimated range between 96.65 on the upside and 94.65 on the downside. Friends, I now turn to the Bank Nifty, which fell on 5 out of 5 sessions, as you can see on your screen now. Each and every day of the week saw the Bank Nifty fall. It lost 2.07% on a week-on-week basis, and it has also tested the 25-day exponential moving average, which is approximately a month-long holding on cost of an average bull. And we need the prevailing market price to be above this average so that it incentivizes the bulls to hold on to their existing long positions and maybe even add fresh buys. Now, the weekly chart on your screen shows a bearish candle that has a bigger body than its a previous bullish candle. That shows the selling last week was more forceful than the prior week's buying. The price is still above its 25-week exponential moving average, which is approximately equal to 6-month long holding on cost of a bull. That means the medium-term outlook is still optimistic, but only for now. Bulls must defend the markets on declines aggressively, or they risk deeper cuts in the week ahead. In the week before last, this index was number 3 on the most volatile list, but it fell full 7 notches to number 10. Now, it's not because the Bank Nifty itself became less volatile, but the worrying aspect for statistically minded and statistically aware traders is that the statistical beta, which is pure price volatility of individual stock futures, jumped up. Now, that can become a challenge unless you're an extremely savvy tactical trader as against a strategic trader. Tactical traders are typically very, very short-term traders. They are micro-trend traders, intraday traders. Micro-trend would mean nothing more than 59 minutes and 59 seconds. So extreme volatility, the way it rose in individual stocks, my friends, is completely spooky to a whole lot of people, which is why the Bank Nifty seems to have fallen, but it's the individual stock volatility that overpowered it, not because the Bank Nifty is any less volatile, which is why I continue to tell you to trade light on my social media accounts. A lot of viewers have asked me, why do you always continue to advise trading light? Why aren't you aggressive? Volatility is the key. And of course, the bid and offer spreads, which I shared with you earlier. This bid and offer spread is a leakage or an extra charge for trading. and it's going directly to the brokers and to the market jobbers rather than come into my pocket, which is what I don't like. If you look beyond the surface, you'll see that there's a big difference between the bank nifty losing volatility or the stock futures gaining volatility. Now, last week I advocated a range between 40,000 on the upside and 36,700 on the downside, which held perfectly well in spite of all that volatility. In the coming week, I expect an estimated range between 39,250 on the upside and 35,900 on the downside. Continue to trade light because the coming week is shorter, 26th of January being a Republic Day, and therefore traders are likely to be nervous, and a price discovery mechanism, the bid and offer spreads, are likely to stay wide. Do stay wise about these things. Treat trading as a business. Know all the costs, all the pitfalls, all the dangers that lurk in the market. Keep your stop losses very, very diligently, friends. Friends, let's now go to the Nifty 50, which lost 3.5% last week, and it fell on 4 out of 5 trading sessions. It also violated its 25-day exponential moving average, which is a month-long average holding on cost of a bull. That means that the short-term outlook is under pressure for now. Note that the impetus chart that I shared with you earlier is showing that the Nifty impetus is rising when the price is falling, which means the downside momentum is gaining acceleration, which is not a good thing. Can it reverse? Yes, absolutely. It can reverse day to day, hour to hour. But for now, the bulls are completely in the dock. All right. So be extremely cautious out there. The price is below its 25-day exponential moving average and the impetus is also rising. So you might see sudden vicious price swings. Let's now go to the weekly chart, which shows a prominent and large bearish candle. The price still remains above its 25-week exponential moving average, which represents a 6-month long holding on cost. So the medium-term outlook is somewhat safe, but for now, that can change as well if the market declines. The other noteworthy aspect is that the previous high remains in place, which means the 18,550 to 18,650 band is a double top in the near term. In the week before last, the Nifty was at number 11 on the most volatile list, but it fell to number 16 because here again, individual stock volatility overpowered the Nifty volatility. That's extremely worrying unless you know how to deal with the volatility, unless you're dealing in some statistical tools to help you overcome this volatility. So the stock volatility is rising, which is why you need to cut back on your exposure, because for average retail traders, it's going to be a big challenge. Last week, I advocated a range between 18,825 on the upside and 17,650 on the downside, which was admittedly violated by a big amount because the low was 17,486. The downside simply opened up. That shows that the range expanded, that too on the downside, and that is worrying, which is why I sent you two WhatsApp special updates about the state of the market, telling you that I expect the markets to fall. I sent you those updates on 18th and 20th of January, well in time, because I was expecting range expansion and beta spikes. Beta is the statistical price volatility. So I've also talked about the Jensen's measure, which is something that hedge fund managers will swear by. And that is something we are modeling our in-house statistical trading model, the IBEX, to use tools like the Jensen's measure, Kelly's criterion, etc. And the Jensen's measure has turned absolutely hostile to fresh, aggressive long positions, especially leveraged ones. So please be particularly careful because the statistical data is not in favor of bulls right now. And if you're a tactical trader, please avoid large big ticket accumulation or bottom fishing of longs. The risks are substantial due to elevated volatility, and in the coming week, I expect an estimated range between 18,200 on the upside and 17,000 on the downside. Can this range be violated again? It's always possible. It's always possible because do remember the spreads are wide, and I've told you a little bit of buying and selling and the prices start moving exaggeratedly because the spreads are wide and there are not too many people offering support or resistance. And it's a short week where people will either want a crowded exit or a crowded entry in 4 sessions and try to do the work of 5 days in 4 days, very simply put. Also, it's an expiry week. So volatility can be higher and therefore, yes, the range can be exceeded in either direction. But I would still say that your emphasis should be on capital preservation rather than absolute alpha. Alpha is absolute profit in rupee terms. Don't chase profit too much in the coming week. Focus on being safe. Now, friends, the index segment done, I come to the most popular segment of the market where I give you 5 stocks which are high beta, high impetus, where you take small exposure, wait for large price moves, and 5 stocks which are low beta, low impetus, where you take big exposure, wait for small price moves. Why the difference? Because, hey, different traders have different risk appetites, different aptitudes, attitudes, and therefore the strategy should also differ. So the high beta, high impetus stock list where you take small exposure, wait for large price moves is led by Naukri.com at number 1, number 2, Z, number 3, Star, number 4, Apollo Hospital, number 5, Glenmark Pharma. Low beta, low impetus stocks where you take large exposure, wait for small price moves is led by Ipca Lab at number 1, number 2, AU Bank, number 3, ICICI Bank, number 4, Escorts, number 5, India Cements. Friends, I now come to the end of this video and I remind you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. Please help me to reach out to fellow like-minded investors and traders by sharing my video and encouraging them to subscribe to my YouTube channel so that I can get my message across of rational, study-based investing and trading. Also, in the comment section, do let me know what you think of my work, what we can do to get even better and help you trade better. And in the description segment below the video are my contact coordinates and a hyperlink to Equity Masters YouTube playlist wherein I give you a couple of trading ideas or share my mind about the broader aspects of the market twice a week. Do subscribe to my playlist there. And there is an offer of a free PDF trading guide from Equity Master. Do avail of this fantastic offer as well. Friends, I wish you have a very, very profitable week ahead, and also keep monitoring your cell phones for your WhatsApp inbox for messages from me. Do stay very, very safe from this Omicron virus, and thank you for your patience in watching this video. Till we meet again in my next, this is Vijay Bhambwani signing off for now. Take care. Bye-bye.